if you're considering a 1031 exchange, definitely don't just take that little tidbit and go do it. Talk to your accountant, talk to a qualified intermediary. Welcome back, everyone, to REI Tax University, where we talk all things tax planning for real estate investors. And we're deep into our series here on depreciation. So hopefully you've been following along, because today we're going to get into the considerations and what to think about and how depreciation can come into play when you sell a property. And as is the norm for us here at REI Tax University, we will let you know if we put something up on the screen that you need to watch and follow along with. But if you just want to watch and follow along and you like and you're hip on watching my smiling mug, feel free to watch along. But otherwise, go ahead and stick your phone in your pocket, minimize this in the background, throw some AirPods in, and listen along as we go through the potential pitfalls to consider on depreciation, how it can come into play when you go sell a property, because these are things that can be detrimental to you as a taxpayer if you don't consider them from day one. So we've been talking a lot so far in our series here about depreciation and bonus depreciation, calculating basis, cost segregations, all great tax planning opportunities and tools. But what can happen when you go sell the property? Can all these items that you utilize to get yourself tax savings in 1 year now become detrimental to you by taxes that you have to pay back in a future year? Yes, they can. If you're not thinking and planning proactively, they can. So let's talk a little bit about what happens when you sell a property, one of your investment properties. So when you go sell the property, you're going to have to determine your capital gains or loss. And the way this is determined is by taking your net selling price, which is the gross price minus your closing costs, commissions, and things like that. That's your net sales price. You take that less your basis, and that's going to be your gains or your loss. Now, if you're not sure how to determine that basis, go back and watch part 2 of our series here on depreciation, when we talked about the importance of calculating basis and knowing the basis in your fixed assets. So let's just say, for example, that after year 2, you decide to go sell this investment property for $500,000. So you sell for $500K, that's your net sales price. The building, you bought it for $450, but your basis is $425. So you're sitting on gains of $75,000. Now they're gonna break that $75,000 up between something called capital gains tax, your long-term capital gains tax since you held this property for longer than a year, and depreciation recapture. Now what depreciation recapture is it's gonna say, did you take any depreciation sooner than you would have if you just took it on a straight line basis? So did you take bonus depreciation on this? Well, in our example that we're using right now, you didn't. You just took straight line depreciation. So you were allowed to take $25,000 of depreciation, and that's what you took. So all $75,000 of your capital gain, it's going to be taxed as long-term capital gains. And that gets taxed at a rate of either 0%, 15%, or 20%, depending on your total taxable income. Now, you may decide to utilize a strategy such as a 1031 exchange or even an opportunity zone fund or one of these other more tax-savvy strategies to defer your capital gains and not have to pay the tax, or at least pay part of the tax on that capital gains. But that's beyond the scope of this video right now. So in the example we just mentioned, it's pretty easy to understand. You have the $500K, you have $425, so $75,000 is your gains, right? You're going to have to pay the taxes back on that. And so you got some perks from depreciation, and now you're paying some taxes back. So if that's the case, then the way to view depreciation in this is it's an interest-free loan from the government, right? It's not just a free expense that you get to take the benefits of, even though your property goes up in value. It is something that you're likely potentially going to pay capital gains tax on, especially if your property is appreciated in value and you have some taxable income, but it's still worth it, right? Because time value of money, again, it's just, if they're giving you the money now and you've planned for it and you know about it and you're going to sell that property down the road, at least you've got the benefit now and you have to pay it back later. And the tax rate's not going to be much worse either way. But what happens when you've taken bonus depreciation and then you decide to sell the property? Well, this is where something called depreciation recapture rears its ugly head, and you need to be aware of it and make sure you know about it. And then make sure you know, when you're using bonus depreciation early on, what your plans are for that property. If you're planning to sell it, then determine, is it worth it to pay that depreciation recapture tax back or not? And spoiler alert, oftentimes it's still worth it to pay that back later on, but you just got to know where you're at, know where your tax rates are now, and know where they could be in the future. So what happens in a quick example where we've used bonus depreciation is, let's say it's the same thing. You sell the property for a net sale price of $500,000, but you used bonus depreciation, and so you actually ended up taking depreciation of $75,000 instead of the $25,000. So now your basis in your property is $450 minus $75, right? It's It's what you had the property for less the accumulated depreciation that you've taken. So you're at $375,000 in basis. You sold it for $500. You now have total gains of $125,000. Now the IRS is going to break that up between capital gains and depreciation recapture to determine how those gains are taxed. So first, they're going to say, what was the straight line depreciation that you were eligible to take based on the timeline that you held it? Well, you'll recall that you had it for 2 years. It was $1,270 a year. So total, you should have taken $25,000 of depreciation. So your basis should have been $425 if you'd done that. And $75,000 of the total gain is capital gains, long-term capital gains. Based on your taxable income, you'll either pay the 0%, 15%, or 20% if you decide to elect out of doing a 1031 exchange or potentially an opportunity zone fund and just pay the tax on that. Now on the rest of the 50K of gain, because remember there's 125, 75 goes to long-term capital gains. The rest of the 50 is going to be subject to depreciation recapture tax. And the way depreciation recapture gets taxed is it's taxed at your ordinary income tax rates up to a maximum of 25%. So you may be at a capital gains tax rate of 15% and your ordinary tax rate might be 22%. You would then pay tax on that other 50K at 22%. But at the most, you'll pay tax at 25%. So these are all things to consider, because if that amount is too high from paying that depreciation recapture tax, then it may have not been beneficial to you to take that bonus depreciation early on. However, if it's a relative wash or if it's close and you just took that 2 years early, we're back to just saying the government gave you an interest-free loan. The other consideration that this may put in play is it may help you determine, should I use a 1031 exchange? Should I use an opportunity zone fund? Should I maybe do a 1031 light if neither of those work, right? And so it can help you make these decisions, but you have to think about this stuff proactively and know where you're at, because if you don't and you're just there and then you think you've got gains of 50K and realize you've got 125 and a good portion of that's depreciation recapture, well, that's when people come into us upset because they didn't know about this and they sold the property and now they're sitting on a heavy tax and what can we do? And there's a month left in the year, right? So those are not where you want to be. You want to know your plan. You want to be proactively planning for your real estate investments all year long. Now, I do want to touch on one thing that we did talk about just for a second in this video, which was the 1031 exchanges. And it's not a video on 1031 exchanges. We'll talk about that in a future video and probably even an entire sub-series, because that's a pretty good expansive topic. But I do want to just explain what that is, since we mentioned it here and you might be thinking about, you've heard it before, or should you use that, right? So what a 1031 exchange does is it says you can take one like-kind property and exchange it for another like-kind property or asset. Essentially, you could take one investment property, you could sell that, and you could be sitting on gains of $75,000. But if you reinvest the money that you got out of that, the whole proceeds that you got out of that, into another asset that's like-kind, so typically it's another real estate investment, but there's also options to do things like oil and gas investments and other stuff like that. There's even Delaware statutory trust. It gets really ambiguous and really crazy with all that you can do. But to keep it simple, you sell your first property, you're going to go ahead and buy another one, you're going to reinvest the whole proceeds. You should probably consider using a 1031 exchange, because now you've got 75K or maybe 125K of gains and you've just deferred that. So all that you need to know as it relates to this right now is that if you were to utilize that, it'll defer your long-term capital gains and it'll also defer the depreciation recapture tax that you would have been subject to. If you're considering a 1031 exchange, definitely don't just take that little tidbit and go do it. Talk to your accountant, talk to a qualified intermediary, do some more research. Once we put up our videos on 1031 exchange, go through those in depth, but definitely make sure you understand it. You know what it does, you know how it affects your basis and makes you continue to track basis in the new property, because it can be super beneficial and it's one of the best strategies to use as you build up your real estate portfolio, but it's definitely not one you should go out alone or without doing a ton of research on. As always, guys, I appreciate you following along with us. I hope you found some valuable content here, and I hope you're a little bit knowledgeable now on how depreciation works and the potential pitfalls that it may have as it rears its ugly head in the form of depreciation recapture and even long-term capital gains tax, a little bit of how that works, and 1031s, things like that we touched on. Hopefully you've gained some of that knowledge and you can take it and use it, put it in your back pocket so that when it comes up for you, you can effectively implement it or be more knowledgeable on it. If you have found the content valuable and you like what we're doing here, guys, please like and subscribe and hop over to REI Tax U. Join us over there in our community where we talk all things tax planning for real estate investors. And be sure to keep following along in our series here on depreciation, guys. In our next video, video, we're going to jump into some additional topics surrounding depreciation, things like the potentially sunsetting TCJA Act and the effects that could have on bonus depreciation, or potentially where it could go if they re-implement some of the bonus depreciation there. We're also going to touch on a topic called a lazy man's 1031 or a 1031 light, which is a pretty interesting topic, but we're going to touch on that a little bit in the next video and how that relates to depreciation. We're going to talk about some of the financial and the lending considerations to keep in mind as you take bonus depreciation, as you take some of these other expenses, because tax planning is great, but you want to keep in mind your cash flow. You want to keep in mind how things look for your lenders and your financing, because it's all going to matter and it's all going to help you build your wealth up faster through real estate investing. Appreciate you guys tuning in, and we'll see you next time.